happy. It looks like there's some budding leaves on some flowers, and hopefully we're moving in a good direction with this craziness we've been subject to over the last 2 months or so. I'm joined today by Sharon Head in the world headquarters of AP Wealth Management in Augusta, Georgia, as well as Tom O'Gorman from our team, Millie Robinson, and I think Clayton Kwame is going to get on at some point as well. So as always, I'm going to let Sharon talk about the technical aspect of Zoom and how you ask questions. So Sharon, take it away.
Sure. I think the easiest way is to use the chat box. So if you'll find your toolbar and click on chat, and you can either send your question out to everyone in the group, or you can send it privately to me, and then we'll read it and answer. And then if you would like to talk, you can send me a message and I will unmute your mic and you can ask questions that way. All right, thank you.
Thank you, Sharon. And we do encourage you to ask questions. Please do during the course of the presentation or afterwards. That's where we really dig into what folks want to know, and that's where we want to guide our presentation as much as possible. As always, we're recording these for distribution, either to you if you want another copy, or for someone else that might help by this. When we're done, it's going to be up on our website, and there'll be links to YouTube and all the other social media areas so you can get a copy. And of course, Millie Robinson, who's on the call today as well, can help you with getting copies of that as well. So topics for today, we're going to talk about the markets. We're going to talk about our investment policy committee meeting and what we talked about in there. And then we'll have our Q&A, which is really where we have the most fun, I think. So give me a second. I'm going to share my screen here. Let's see. Okay. There we go. So again, welcome everybody. I'm just going to run through this very quickly for folks who have not been on here before. Over here to the right, that inverted triangle is our approach to investment management. At the top of that triangle is asset allocation. That's what we base all of our decisions on, and that's based on your risk tolerance and your time horizon. And down at the bottom, you'll notice security selection or stock picking adds the least amount of value, and this is not something that AP Wealth Management or our team put together, but this is a study that was done a while back by some folks who are a lot smarter than I am. And then here's a little bit more information. We'll focus a little bit on in the bottom right corner of these portfolio groups today. We'll talk about those: attain, relative return, opportunistic, and protect. And over to the left, I'll just remind you that total return is equal to income plus capital appreciation, or capital depreciation, as we've seen in the last couple of months. So the market, what's happening? What's going on? It's been pretty good, and I've got some slides today. I think everybody was favorably disposed to the slides we had last time. So this slide is entitled, "What a Difference a Month Makes." So what you see here, each color bar, it represents a different time frame. So the yellow represents the entire 3-month period from February 19th, 2020 to May 19th, 2020. And those are represented here, all on the bottom. Then moving to the right, the rust colored bar is the February 19th, 2020 to March 23rd, 2020. And then the green, which is aptly colored, represents the period from March 23rd to May 19th, 2020. So let's dig into this for just a second. And I think what you'll see and what becomes very apparent is one of the axioms we referenced when we touched on, when we first started these briefings, is don't look. The market will take care of itself. It doesn't mean bury your head in the sand or don't pay attention to what you have or what's going on, but just look at the volatility, the ups and downs on this graph. It is absolutely all over the place. And what's most telling is, let's just look at energy over here. Energy had on the left side, the worst period between February 19th and March 23rd. March 23rd was when we were at the low point so far. But it's also had the biggest recovery since March 23rd as well. So energy has been incredibly volatile and is still down almost 31% for the last 3-month period. But it's been incredibly volatile. And the only thing that's going to happen, just as a reminder, if you look at your accounts every day, or you look at them 2 or 3 times a day, this sort of information is going to drive you crazy. So as you've heard before, you'll hear many times in the future, be in the right place, pay attention to what's going on, but don't look at it every day. And sometimes just don't look. So moving from left to right here, let's just talk about a couple of these sectors and kind of what's going on. We referenced energy. Energy is all over the place. Energy has made, as you can see, quite a recovery, and that's a demand. And as we've referenced, that's a demand issue. And as we've referenced before, when there's uncertainty about people using fuel and driving and being shut in, no one's going to need gas. Now we're starting to see people, these shelter-in-place rules are really being liberalized, and people are going to be able to move. They're going to be able to go out and buy things. Energy is going to be in more demand. Materials are the raw materials that are used in production and so forth. And then just moving across, the other one I want to talk about briefly is financials. Over here to the right, financials have really had a hard time. Those would be banks and so forth, and because of low interest rate margins, but also because of what's going on in the economy. So I think that's just a really good slide on what's happened and the sheer volatility of what we have all experienced over the last 3 months. It's all over the board. So here's our some notes from our investment policy committee meeting. This was on May 11th, just to review what an investment policy committee meeting is and what we do. It's where we get together and we really tear apart the investments that we have and the investments that we're using, how they're performing, and really get into some minutia. I'll run through our agenda very quickly because I do think it's important that clients and future clients know what we're doing. The first thing on our agenda is our attain, relative return, and protect areas of our portfolios performing appropriately. The second thing is we review our opportunistic portion of the portfolio to see if we ought to remove something or put something in there. 3, we review client portfolios in great detail. We'll select a sample of that we rotate through of client portfolios, and we'll really dig into them from a tax standpoint, from a risk tolerance, from a time horizon, from a cost standpoint. And then we'll also check in on our investing principles. Are we adhering to our investing principles that we put together, and are we staying the course? And then our final issue is, are there any other things to be brought before the committee, bad or good, moving forward? So let's dig into this slide and a little bit about what we talked about. As we've talked about previously, we preferred cash to bonds because the 10-year Treasury is down at 0.7% right now. Just as a reminder, that's 0.7%, not 7%. So we're not going to accept a 0.7% for a 10-year bond. We're just locking ourselves into a really, really poor return. So we've moved some money, and we'll continue to move some money to preferred stocks. Preferred stocks are a hybrid between a stock and a bond. We purchase those for income. We're certainly not moving all of our cash to preferred stocks, but we are moving some. One that we looked at is the symbol's called PFF, and I put no leverage there because one of the things we talked about and look at is some of these investments in mutual funds will use leverage, so they actually borrow money to make their investments. So they've got a debt portion as well as an investment portion, and if things go sideways, they can go sideways really quickly. The next item down we talked about was moving to a Vanguard Core Admiral Bond Fund. We've used a couple of other bond funds in the past, and we'll continue to use those bond funds. But as this is an example of are we using what we should in our Protect portfolio? And the main reason we're going to start using the Vanguard Core Admiral Bond Fund is lower fees. It's a 0.1% fee ratio. Then we also talked about REITs. One of our favorite REITs, it's an exchange traded fund, is VNQ, which is a Vanguard REIT. It's yielding 4.1%. We think that's probably worthy of some money. Just as a reminder, a yield of 4.1% means no matter what happens to the price moving up and down, it's going to pay in cash 4.1% based on the purchase price. Then opportunistic, which is where we look for value, perhaps areas or sectors or investments that are beat down. We had a really great discussion around opportunistic, and this is what came out of it. Will our opportunistic investment recover or grow faster than the appropriate index? By way of example, let's say we wanted to buy an energy stock that was in the S&P 500. Just as a reminder, the S&P 500 is the 500 largest US stocks. Well, if we bought that energy stock, is it going to recover faster than buying the S&P 500? If it's not, or we don't think it is, then we ought not buy it. I just thought that was really good. That was not my idea. I think that was one of my coworkers' ideas, but really, really good. A couple of other notes. We've got a watch list here of things that we're looking at. XLE, XLF, and XTN. Those are all exchange traded funds that focus on energy, transportation, and financials. So we're watching those because a lot of those have been beat down and have some value. That doesn't mean we're going to use or buy them, but when we put them on our watch list, we're paying really close attention to them. This is really interesting. One of our favorite mutual funds that we like a lot, we really dug into it. We've got a heavy allocation to it. And we looked at what was in that mutual fund, and we found that they have no allocation to real estate or energy. So what's really interesting about that is a very, very, very successful mutual fund that certainly looks at opportunistic investments as we do, has not entered the energy market at all and has not entered the real estate market at all. So just really interesting. And then another point that we discussed was absent a strong conviction when it comes to opportunistic investments, we'll defer to a mutual fund manager. And what that means is, let's take energy, for example. We talk about energy and we talk about how it's performing or not performing and how much value might be there. But if we're not really convicted about energy recovering perhaps as quickly as the S&P 500, which I referenced earlier, then let's let a mutual fund manager make that decision. And our job is to look at our clients and make sure we're adhering to what they need to invest in based on their risk tolerance and time horizon. Then I put this in because we did delve into some airline stocks, and we've talked previously about if you're going to make an investment, look at the balance sheet. Make sure they have a strong balance sheet. So as we looked at some airline stocks, we looked at Delta versus American, and it became really, really clear that Delta's balance sheet is much stronger than American's, and that's related to their debt. So I just wanted to let you know a few things that we talked about, a lot of other things at the Investment Policy Committee meeting, but those were some of the highlights. So we've had a good market the last few days and the last few weeks. Today was a good day based on a previous day that was a good day. Monday wasn't so good. But as we've said many times before, there are still a lot of unknowns out there. We're opening up. Lots of things are opening up. A lot of folks are coming out of shelter in place, but it's going to be a different economy moving forward, and we're going to operate differently moving forward. And I thought this was a great slide about how that illustrated what's going to happen to some businesses moving forward. So our compatriots at UBS predict that nearly 1,000 stores will have to close over 5 years as more shopping shifts online. So we knew shopping was going to shift online, but as folks were at home, working at home, not able to go out, that really accelerated. And I thought this was really interesting. So office supplies, which most of us would consider a commodity, papers, pencils, scissors, those sort of things. Look at that, 50% of stores will be closed in 5 years. That's really, Office Depots, the Staples, all those sort of things. That's really an amazing statistic. And then consumer electronics, sporting goods, home furnishings. I'm certainly no decorator, but I know people like to sit in chairs and sit on couches, at least I do, and certainly lay on mattresses before they buy something. Same with clothing and accessories, but moving on down, general merchandise, home improvement, auto parts, you can see those won't close quite as much. But I thought that was really telling statistic that something as simple as office supplies, half of those stores will be closed in 5 years. And the other interesting part about this, and it reflects back to the mutual fund that's not investing in real estate, as we move forward and perhaps we work more remotely, and in addition to that, people are not going to go into stores. Real estate is really going to have to deal with how they get over what's probably going to be excess inventory from a real estate standpoint. It'll be interesting to see what happens there. I thought this was interesting as well. China wants to play again with us, although we are having a trade war and swords have been crossed over the last week or so, and that's hurt the markets in some ways. If we compare 10 weeks of agricultural purchases from 3 years ago with China to the last 10 weeks during this pandemic, ending in May 7th, 2020, China has actually purchased a lot of farm goods and a lot higher than prior to the trade war. And I just thought that was interesting because of the other things I've mentioned. I think China is likely to struggle moving forward because of their role or not role in what we've seen here, but they're going to really have to work. And I can't help but wonder if this isn't extending a bit of an olive branch by adhering to some of the trade agreements that were previously put together. Okay, then as we know, and as we talked about previously, we're going to have a flu season. So when the flu season comes in October or November, is it going to be our traditional flu season, or is it going to be the coronavirus flu season? Who knows, but we know it's coming. It's just how severe is it going to be, and are we going to close things down? It'll be really interesting to see, and it's an interesting time. So I thought this was a really good slide and really good information. When we do have a second wave, whether it's COVID or whether it's the typical flu, voters were asked whether they would support or oppose the following measures in the event of a second wave of cases of coronavirus. And so almost 90% of people say, yeah, we'll be quarantined up to 14 days. And it's interesting because that's in large part what drove this downturn is people being in quarantine, not being able to go out. So I think there's going to be some unknown moving forward in the economy when this comes, and how do you plan for it? How do you get ready for perhaps another quarantine of some sort? Social distancing, I think we've all accepted that. Federal aid, we're giving money away, lots and lots of money away. Wearing face masks, federal aid to U.S. citizens, stay-at-home orders, and then closure of non-essential businesses. It was just really interesting to think about what's going to happen in the fall, and more importantly, to this slide, how we're going to react to what happens in the fall. I think that's really interesting. So just as a reminder, we're going to take some questions now and wing it, if you will. But the strategies that we've talked about in the past are still important and pertinent now. And those are, if you recall, tax loss harvesting, although you don't likely have as many tax losses based on the first slide I showed you that you did when we first ended this craziness. Rebalancing, long-term rebalancing is always a good idea. Rebalancing back to your target allocation based on your risk tolerance and your time horizon. And then, as always, Roth conversions are certainly worth looking at. We've done a lot of modeling for clients with Roth conversions and are happy to help in any way that we can. And the Roth conversion, just as a reminder, is not just about the downturn in the market, but I think it's also really pertinent to the taxes that are going to have to go up based on the amount of money that we're loaning and spending right now. And I also just saw, there was a piece of news today that said the birth rate is the lowest it's been in 35 years. So if the birth rate is the lowest it's been in 35 years, that means 20-year-olds who typically supply Social Security or support the market by 20 years from now by putting money into their 401k are not going to be there. So demographics play a part in that Roth conversion as well as taxes moving forward. All right, enough slides. I think we've heard me talk enough. Sharon, I think I saw some questions pop up. Let me see if I can.
I don't have any. Maybe they came to you, Gene,
Okay.
just privately to you. I don't have any on.
All right. Yes, I do see some questions here. I'm going to go back to sharing my screen so you don't have to look at me. Hang on just a second. Okay. So let me go to more. There it is, chat. Okay. Do you like airline stocks? Airline CEOs state it is a 3-year recovery. Right now, no, I don't like airline stocks for a couple reasons. I just, we'll talk about this in our next investment policy committee meeting. And I'm gonna estimate here because I can't remember the exact statistics, but a 737 right now, if you take out the middle seats and use social distance with what they're doing now, the maximum capacity they can have on a 737 is something like 60%. Well, the break-even load factor or capacity just for the airlines to break even on a 737 is 77%. So in order for a plane to fly and be profitable, it's got to be 77% full. So something's got to give there. And it's either got to be a different way to fly or prices going up or something. But yeah, they're going to have a really hard time, I think, moving forward. And the other part about what we're doing today, instead of businessmen and women getting on planes, do they do Zoom chats? And of course, business folks are the most profitable segment of airlines. So embedded in your question is, and I think this is, are they so undervalued that they're worth buying now? And I don't think they are, because we've still got a lot of uncertainty to figure out. And as I mentioned in previous briefings, we're in the risk management business, so that'd be a very risky investment right now. Airlines would be my take. REITs will have stress due to online transition you discussed. Do you think it will outperform the S&P? Will you segregate REIT exposure to stick with apartments or data storage? Very good question. Do I think REITs will outperform the S&P? Depends on what time frame. I think over the next year they probably will. Over the long term, as interest rates normalize, I don't know. I think probably they will have a challenge to do that, because once interest rates rise, REITs are going to have some competition because they're such an income-oriented investment. Will we stick with apartments or data storage? Both are going to be a challenge in some regards, but the apartment thing is a really interesting question, because the birth rate's low. There are not many folks that are going to be buying houses moving forward, because they're going to be young folks moving into the housing market, and the birth rate's been low for a while. So I think it probably bodes well for apartments. But if you look around the Augusta area, and I can't speak for the rest of the world, there are an awful lot of apartments going up, and I think we're probably going to have some issues there that will affect the REITs. About the last slide, the flu will come back in the fall. How do we respond? Well, that's the $64,000 question that I don't know. My sense is, and this is just anecdotal, is that we're going to have such a severe attention that the word is escaping me. We're going to be so on edge about any flu or any disease that we're probably going to overreact. Did we overreact this time? Who knows? Only history will tell us. But I suspect we'll likely overreact because we have to. And as many of you have probably seen in the most recent bill that was passed to generate money, what one party wanted was to limit liability of folks that are opening back up. And I think the liability issues are going to be huge. But to answer your question, I think we probably appropriately overreact. And it also depends on if we have a vaccine or the promise of a vaccine. I know in the last few days, Moderna and some other folks have had some promising results, but they still have to go through trials and they still have to figure out whether that will work. Sharon, how we doing? You got any?
We're good. No,
we have so educated our group here that we've answered all their questions in many regards. We'll give them a little bit of time. Tom, anything that I've left off?
No, I think that's good. I continue to read a lot, and the more I read, the more I'm convinced that we don't know how this is going to work out. I know a lot of people think they know how this is all going to come out. It's interesting, the market rally off those March 23rd lows is really quite amazing and really difficult to understand given all the headlines and everything we see going on around the rest of the country. My family's all up in New York, and it's not a good situation up there. So really, really interesting. But I'm pretty sure we've got a lot of volatility ahead of us before this is over.
Thanks, Tom. Another question: do your concerns about the airlines apply to cruise lines as well? Yes, they don't. I don't think they have the same issues with social distancing, but I mean, you think about a buffet on a cruise line. I've never been on a cruise line, but they're going to have to change completely the way they do business and hire people. And I remember I had concerns about getting on a cruise because it seemed like they were having coronavirus issues way before this even happened. You just and got an awful lot of bad press. So I think they're going to struggle as well. Again, our cruise lines, like airlines, so far down that they're of value now. I can't answer that question, but they don't fit our risk profile just yet based on how low they've gone.
And we do have another question, Jean. It's any thoughts on the Fed this week talking about keeping the interest rate at or near zero for the foreseeable future? How does this affect the market, the economy, and our investment strategy?
Great question. Yes, the Fed, I'll talk briefly about the Fed, and this is my personal opinion. They've really done a pretty good job during this process, communicating and acting. Interest rates near zero, a couple things should happen. When interest rates are near zero, that means you can borrow money very cheaply. It should push all sorts of spending, but you have to have confidence and you have to have a job and you have to feel good about where you're going. Zero interest rates provide a lot of liquidity. So that should provide lots of spending on cars, on homes, on all sorts of things. It also should help real estate because if you can borrow cheap money, that's going to effectively push up the price indirectly of real estate, but also make it more attainable moving forward. The flip side to that is investing in fixed income is really, really, really a challenge. As I've mentioned in previous briefings, we preferred cash over bonds because when the Fed lowers interest rates, they don't directly lower the bond interest rate, but it certainly has an effect on interest rates coming down on bonds because the Fed, who has access to a lot of data, says, we've got some concerns about the economy, so we're going to bring our interest rates down. And the bond traders who really control long-term rates also pick up on that. So I hope I've answered that question. There's a good side to it and there's a bad side to it, but that's always the case.
Gene, if I can jump in on that one as well.
Yes, sir.
this is a really favorable environment for preferreds. That's why we
Sure.
decided to jump in
Thank you.
in our last investment policy meeting. Preferreds can be very dangerous in a volatile interest rate market, but when the Fed is basically telling us they're going to be low for a long time, it's a really favorable environment for preferreds. So, as you said, if you're getting 1.4% on a 30-year bond, but we can get 4 to 5% on a preferred, that's really helpful.
Thank you, Tom. Excellent. Sharon, any other burning questions?
I don't, there's no more in my chat box.
Well, while we're waiting for that next question, we're going to do something new today, and hopefully it will work well. We're going to have a poll. And we've really enjoyed these briefings. We've enjoyed doing them. We've had great feedback for them. They've actually gotten kind of fun to do them. So we want to know how often we should hold these virtual briefings. So hopefully on your screen is a poll. Somebody give me a thumbs up if there's a, okay, excellent. All right, great.
Yeah.
So if you just take a second and click on that, that will help us determine how we move going forward. Our plan right now is to do something bi-weekly, but as we get more confidence in what the market is doing or not doing, we'll adjust as necessary. And as always, please give us your feedback via email, via social media, via whatever, as to the topic and your questions and so forth, because that's very valid and very helpful to us. Okay. I think we're ready to sign off. Any final comments, Tom, Sharon, Millie? Okay. Oh, there's Clayton. I got one more. Hello, Clayton. Well, as always, we're grateful for your support, for our clients that are on the call and future clients that are on the call. We're grateful for your support. If someone can benefit from this information, please let us know or send them the information. We hope it's been helpful to you. And have a great Memorial Day weekend. Hopefully this will be a kickoff to a good summer that gets better and better every day. Be safe out there. And again, thank you very much.